Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value and entertainment out of these videos, I'll ask you to hit thumbs up and subscribe. Questions, comments, put those below. Yes, as you can tell, we're at a different locale today. I'm currently away on vacation in Tofino here, so I'm going to keep this video relatively brief and short. I've never missed a Saturday video, so I'm not about to break that streak. So I will, thanks for sticking tuned to this week's video here. But what I want to touch on this week is I'm sitting here, on vacation, reading my Bloomberg, is that, the market was anticipating the U.S. jobs numbers coming out, and we actually exceeded or surpassed market expectations on job creation. And what I think is interesting is that the market reaction to that headline figure coming out was that bond yields actually sold off. And I think this is really a telling story that's been playing out in markets, particularly over the last month, is that you're seeing this narrative about, inflation, the reflation, the big reopening trade, higher bond yields because inflation's going to take hold. And what we're actually seeing is over the last month, that trade has been kind of selling off. Or consolidating, if you will. So what you're seeing, you can see it, for example, in lumber prices and a lot of other commodities. We're seeing it particularly in the housing market, which of course I'm going to get into in this video. But what you can ultimately see is that, so you have bond yields selling off today, despite the labor market seemingly getting better. And what ultimately this means is the market had already priced this in. So the market is ultimately looking at this and saying, okay, well, hey, if the recovery is perhaps quicker than expectations, this might mean central bank liquidity gets drained out quicker than we anticipated. This is ultimately a net negative for the asset markets. And so that's kind of how you're seeing things shape out in the markets right now. Again, whether you agree with that or disagree with that, what happens in the bond market is particularly important, especially for an asset such a, levered asset like real estate, which is basically trades off the bond market. So when you have yields selling off basically I would say on good economic news, that suggests to me that the bond market anyway believes that we're going to be in a lower rate environment for a longer period of time. And so, again, we're seeing this consolidation, things like the lumber market. What we're seeing playing out, right now in the housing market, for example, there's not just a Canadian story. It's a U.S. story as well. So what we can see is in the recent economic data from the U.S. mortgage purchase applications, the MBA index. What you can see is that is consolidating, that has been selling off. So you're seeing, again, some obvious slowdown that's happening in the U.S. market, and I've documented ad nauseum here the Canadian housing market as well, which ultimately shows every single sign that it peaked in March. Now I'm sitting here looking at some of the recent data for the Vancouver housing market for the month of June, for example. We just got those figures coming in. Sales again fell. So basically what we saw sales ramping up. They hit record highs of any single month ever, all-time record highs in March of this year. And ever since then, they've been slowly sliding down. They've dropped 4 consecutive months now in a row. Now, again, that's somewhat of a typical, summer seasonal pattern where housing market slows down. But, to see it really peak in March, that's an early peak. Usually it'll peak around April or May. So we peak in March and we slowly start to roll off every single month. And we're also seeing, what I think is what is actually holding up the market right now in terms of prices is that, new listings are also dropping off. And this is ultimately, in my opinion, I've talked about in interviews with Yahoo, BNN, and obviously on this channel, is that, listen, I said several months ago that we were going to enter into a period where, particularly here in BC, we're now reopening the economy. People are desperate to get out of their houses. I'm here in Tofino on vacation. So you've got realtors going on vacation. You got home buyers, home sellers. Everybody's desperate to get out of the house. So this whole pandemic-induced housing boom, where people were locked up in their houses, desperately wanting more space, renovating their kitchens, their bathrooms, etc., is you're seeing that now as we reopen economies, as we slowly get back to normal. You're seeing NHL stadiums, for example, filling up with fans again. As you get back to this normal, the priority of your house become, that trade sort of starts to unravel somewhat. So, and again, that's not to suggest that imminent weakness in the housing market is coming, but listen, we just had a 30% run up in the housing market. And I strongly believe that in the summer months, we're going to see a significant cooling off period, which we're already seeing. I mean, just look at the sales to actives ratio now here in the Greater Vancouver detached housing market, which was the hottest segment, right? You're seeing that, ultimately, again, peak in March, slowly rolling off. And, I think what the true test now is going to come in the fall. And so a lot of this is going to come, like you can see policymakers are really trying to grasp or grapple with, like, nobody's really experienced, like, a pandemic in recent modern history where, we have global supply chains completely being disrupted, which is creating massive year-over-year headline inflation. Central banks arguing that, oh, don't worry, this is just transitory. You've got this massive run-up in housing. How much of that inflation is from housing? And how much of this is just, again, base effects or human emotions that are driving sort of irrational, like we can see in the... you can see not only in the housing market, like global housing sales, obviously, going through the roof, but also global car sales, right? Everybody's saying, hey, hold on a minute. I don't want to take public transport anymore. I'm also moving to the suburbs, so now we need that second car. But you've got this scenario where, because of global supply chains being disrupted, there's a delay in getting cars manufactured and shipped, and the chip shortage. And so it's interesting because you can see, like, for example, used car prices absolutely took off. And, now we're seeing, so new and car sales as well exploded. Now you're seeing car sales, drop off significantly right along with housing, right? So this is all part of that same trade. And so, again, I feel like that narrative around inflation and, skyrocketing out of control, I still feel like we're in this sort of deflationary backdrop. Now, don't get me wrong. The problem with inflation is that, it's ultimately measured based on CPI, which is a horribly flawed index, just the way that it is measured. But, ultimately, central banks are making monetary policy decisions based on this flawed metric, and you have markets moving trillions of dollars worth of asset based on a broken model. So that's when I talk about inflation, I'm saying strictly looking at the CPI inflation. And don't get me wrong, we're going to continue to have asset price inflation, because that's ultimately what QE has done, right? It has destroyed basically money velocity. But you've created this excess liquidity. You basically have too much capital chasing too few assets, and that's where really all your inflation is showing up. So kind of just wanted to touch on that. Would love to hear your thoughts, obviously, in the comments below. I think there's always an interesting dialogue between, again, inflation, deflation. Are we entering into this sort of roaring 20s period where you've got this pent-up demand, or are we sort of now off this sugar high over the last sort of 6 to 10 months of central bank induced liquidity, a housing boom that was spurring additional economic activity? And as we reopen the economy, are we going to come back down to reality of, hey, this is going to be a little bit of a tougher slog to get through? I mean, the one positive is that if you look at, the economic jobs, now again, this is the U.S. I think the U.S. has better data on this. But if you look at, U.S. job permanent losses after each recession, you can clearly see, at least on the positive side, that this pandemic-induced recession is certainly not going to be. It doesn't appear to be as scarring as previous recessions, and hopefully we'll get out of this sooner rather than later. But anyways, that's my thoughts for this week. I hope you guys have a great Canada Day long weekend. As always, we'll see you back in the regular studio for next week.